Okay, so we are looking at question number 2. Okay, so someone should take the question number 2 for us. Okay. Before we even start reading the question, who is going to be the parent here?
Son.
Okay, so let's go and look at the reporting dates. That will be 31st March 2017. Okay, so you can go and put your structures there before you wait reading the footnote. So let's go with our structure. So okay, what is the first item that will come here? So let's have our assets here. Then we have the non-current assets. What is the first non-current asset in the question? Our first non-current asset is what? Is property, plant. Property, plant, and equipment. So you bring your PPE. What are the figures?
Six, 3, 9, 3, 4.
639 and 340. So we put that together. 639 9 340. What is the second?
Intellectual property.
We have the intellectual property. How much is that?
Debt.
Okay, okay. The investment will always cancel. So you can bring it and cancel it. There's no problem with that. So we have the investment. Okay. Investment can be the amount that we are buying the subsidiary, or we can have some other investment. So we can put it over here and go and reconcile. Okay. So we can leave like maybe space like 3. We might be having goodwill, we might be having investment in associate. We can just leave a space like 3. Okay. So leave like 3, then you come to your current assets. Our current assets, what is the figure there?
160 and 70.
160 and 70. So we have 160 plus 70. Go to our equity and liabilities. Our equity and liabilities. The equity component, which one are we going to be bringing?
Parent.
Okay, so we bring the parent equity to be So let's go to the question, what is the parent equity? Equity shares is what? It's 300.
Correct.
Okay. So we have equity shares of the parent. Have it. Okay. Then we have the group return earnings. Do you have any other component of equity or revaluation reserve in the question? Okay. We don't have, we doing what? What will be the next item under the equity and liabilities?
The non-controlling interest.
Okay. We're doing the non-controlling interest. After the non-controlling interest, we have non-current liabilities. We have
Yes, sir.
current liabilities of, so we now come to non-current liabilities. Non-current liabilities, what do you want to go about there? We have 10% limit. What are the figures like 10% limit?
120 and 20.
120 and 20. So you can leave a space, maybe you might be having a different item under current liabilities. So you come to your current liabilities. What is the figure that we are having for the current liability?
280.
So we have 208, 200 plus 8. So after doing this, then you can now your workings for the, let's go to our workings. We can have our workings. The first workings will be what? A, a glue structure, which we all know how to put the, you read through the question to determine your group structure. Okay. So you read through the question to determine your group structure. Okay. So let's now start reading the question now. Let's start from the top. Okay. So after this one, the group structure, you have your net assets. So let's just go. So the group structure, you read the question and put the group structure there. So you have net assets. Okay. The net asset will be for the subsidiary who is named. So we have at acquisition, we have acquisition, and we are going to be having reporting. So what will be the first item that will come under the net asset? What will be the first item that will come under the net asset?
The equity
Ordinary
shares.
equity share or ordinary share.
Okay, so we have the equity shares. Okay, so what is the equity shares for the subsidiary?
200.
That will be,
120. 200, sorry.
okay, that is 200.
It's 20. Okay.
That will be 200. Okay, so we have the 200. We have the 200. So the next one will come, that will be retained earnings. Okay, the retained earnings, you always have to look for the date of acquisition and determine the retained earnings at the date of acquisition. So let's go and see when the parent or when the subsidiary was acquired. The subsidiary was acquired on what?
1st April
1st
2016.
April
20.
2016.
Okay, so what is the reporting date now?
31st March 2017.
Okay,
The first March 2017.
so that is a full year acquisition, isn't it? Okay.
Yes, sir.
You ask yourself, do we have retained earnings at the date of acquisition? What is the retained earnings at 1st April?
120.
One what?
120.
Okay.
120.
So you can see that you are giving the retained earnings for at the acquisition and also for the year. Okay. So we have 120. So 120. What will be the retained earnings at the end of the year, which is 31 March 2017?
140.
140.
That will be the opening balance plus the profit for the year. That will give you 140. Okay. So you can leave this one to now determine other items. So there might be other liabilities that were not taken into consideration. There might be assets that are going to be increasing. So if this expense, then you count your 23, then you count your goodwill calculation of goodwill. So you have your purchase consideration here, then you can hold your purchase consideration. So you can put that one there, then you move on to NCI. So you can come here and have your non-controlling interest. Come here and have your non-controlling interest. You can say fair value at acquisition. Do you have any fair value at acquisition? We are going to determine that. uh, You can move to this place and have your group return earnings. Just have to open everything down. Okay. So our group return earnings, it will be the parent earnings that will come first. So the parent return earnings, you can always determine this from the statement of financial position. What is the parent return earnings for the year?
300.
Okay.
300.
That will be the 210 plus 90. Okay. That will be 300. Okay. So let's now start reading. So this will be 210, which is the return earnings at the beginning plus the profit for the year. So we don't know whether there will be an investment in associates. So we can be reading the question to see whether we have investment in associates. So after doing this, then you now have time for question now. Let's start reading. Stop there. So let's start reading from the top. What is happening there? Who is reading for us?
Sam acquired 600 million equity share in Moon on 1st April 2016. The purchase consideration was made up of a share exchange of
Oh,
one share in Sam
please,
for
please,
two shares in Moon.
please. You need to determine the group structure, isn't it? You are not giving a
Yes,
percentage,
sir.
but you are giving number of shares. They are saying that you have acquired 6 million of the shares of the subsidiary. But the question is, what is the total number of shares that you are acquiring? 6 million out of it. What will be the total number of shares of the subsidiary before you are acquiring what? 6 million.
800.
That will be 800. How do we get the 800 there?
You get 200 divided by the share price.
25%.
So, how many we are issuing a share at 25 pesos. So the question is, how many shares will you issue at 25 pesos to get a value of what? 200. So that will be 800. So if you want to find your group, the percentage holding of the parent, how do you find that one?
Is the,
Yes,
yeah, the
The 600 over what?
over the percentage there, over the 800
Okay,
times 100.
multiply by 100. What are we having?
75.
That will give you 75, isn't it?
Yes, sir.
Okay. So the NCA will give us what?
25.
Okay.
25.
So hence here will be 200 over 800 multiplied by 100. So that will give you 25. So you can determine your group structure. You put your acquisition date there, your post-acquisition date, and your post-acquisition, your reporting date, and also your post-acquisition period. Okay, uh, that is not an issue. So any profit that a subsidiary is making, we are going to be having, or the parent is going to be having 75% of it, and NCL will be having 25% of it. Have that in your mind, then we move on. Let's come to what they are saying here. Okay.
The purchase consideration was made up of a share exchange of one share in Sun for two shares in Moon.
Okay. So how do we do that? A share exchange of one share in Sun for two shares in Moon. So what will be the proportion?
1/2.
Okay. So we are going. So we first go to the the share the purchase consideration. We have share exchange. That's the first consideration. Share exchange will be 1/2 multiplied by how many shares are we buying?
600.
Okay. Multiplied by 600. So it means that we are going to be giving them 300 shares in return for 600 shares, isn't it?
Yes, sir.
Okay. So these shares will be given to them at what? These shares will be given to them at what price? Count to the down before the statement of financial position. What can you see there?
75 pesos.
Okay. The value of each share, of each Sun share at the date of acquisition was 75 pesos. So the 300 shares will be given to them at what? At 75 pesos. So 0.75. What are you having as the what? As a share exchange?
225.
So 300 times 0.75 will give you 225. Okay, the question is you ask yourself whether the share exchange has been recorded. No, it has not been recorded before the because the investment that we have is only 121. If the share exchange should be recorded, it will be more than that. Okay, look at it. Look at there is some information here. Okay, look at this one. Sun has only recorded the issue of the loan notes. Sun has only recorded the issue of the what? Of the loan notes. It means that a share exchange and a deferred consideration has not been what? Recorded. What will be the entry for the share exchange now? We are debiting the investment. The corresponding entry will be what? The corresponding entry will be what? We debit.
To credit the equity shares.
So the equity shares of the parent will increase by 225. All right. Let's move on. Okay. Yes, please take the next one, which is the issue of the 100% loan note for every 500 shares worth acquired. Okay. What is the meaning of that? The issue of 100 Ghana cedis 10% loan note for every 500 shares worth acquired. What is the meaning of that?
Is this a ratio of allotment? So we take 100 over the 500 times the share acquired.
Okay. So they are saying that for every 500 shares of the total shares that are acquired, we are going to be giving 100 cedis loan note to them. So the loan notes are going to be issued in what? In units. And a unit is 500 what? Shares. A unit is given for 500 shares, and a unit is valued at what? At 100 cedis. So the best way to go about this is that you ask yourself, how many units are you going to be giving to them out of the 600 million shares? So you can have your 600 million shares. Okay, your 600 million shares divided by 500 then you get a unit, then you multiply by the what? The amount, which is the same as 100 over 500 multiplied by the 600. So let's go and see what we are going to be having there. So we have the loan note has already been recorded. So we have the 100 over 500 times what? 600 million. What are you getting?
120.
So they say only the loan note has been recorded. So let's go to the statement of financial position and see what is the investment there. The investment is what?
Investment is 121.
Okay. It should have been 120. They recorded only the what? The loan note. But why are we having 121? We'll come to that one later. But what you do is that you have to go and remove your investment because this will cancel the share capital of the subsidiary. So this will cap. So you count your investment and subtract 120. Where the one is coming from, we will determine that one, and also if it will be other investment or there is something that they are adding to the investment, we will find out and cancel it. Okay. So that has already been recorded. It means that the interest on the loan note has also been what? Recorded for the year. We only bring the interest on the loan note into the equation if that particular transaction has not been what? Recorded. But they have recorded the issue of the loan note already. It means that the interest for the year has also been charged to profit or loss already. So we don't do anything on that. We only bring those things when the question says that it hasn't been recorded. It means that the loan note is not in the books in the first place, left alone what? The interest on it. But this has been recorded already. So the loan note will be there and the interest has also been what? Has also been charged. So let's go to okay, let's come to the third consideration. Third, cash payment of 11 pesos per share acquired payable on what? 1st April 2017. Okay. Okay.
On wine.
Okay. We are paying this in what? In a year time, isn't it?
Yeah.
Okay. The question is, what is the value? What is the amount that we are going to be paying them on 1st April? You have to determine that first. It is 11 pesos per the number of shares that you are acquiring. So what will be the value? What will be the amount that you are going to be paying them?
We acquired 600 shares times 11 pesos.
So we have the 6 million shares multiplied by 0.11. What will be the amount that we are going to be paying?
56.
That will be 66, isn't it?
Yes, sir.
This amount will be paid in a year time. But the question is, there is an interest element over here. So if you have cash today, how much are we going to be paying them? We present value this amount. How do we present value that? This will be
Cost of capital must be given.
so we have the deferred consideration or the deferred payment will give you the amount that you are going to be paying, which will be 0.11 multiplied by 600 divided by the cost of capital or the discount rate. Okay, what is the cost of capital for the company?
10.
Okay, so that will be 1.1 exponent what? 1, because we are paying this just in a year time. Okay, how much are we getting?
60.
Okay. So, but how much are we paying them at the end of what? At the end of the first year, or in a year time? How much are we paying them?
66.
So what is happening there? But today's value of that amount is what? 60, and we are paying them 66. What is the meaning of that?
Yes, because of the interest.
So we have a finance cost. You don't have to calculate the finance cost again. So you just come here and have a finance cost of what? Finance cost of 6, which will be 0.1 multiplied by the 60, and that will be a cost to the entity. But the question is, was the deferred consideration recorded?
No information about that has been.
Okay, they say some okay, some has only recorded the issue of the loan note. So the deferred consideration has not been what? Recorded. But since we have recorded this now, we have debited our investment and we have also credited our retained earnings with the interest. Our deferred consideration will have to be what? Recorded as a liability. But which type of liability?
Non-current.
No,
Current liability.
look at the date.
Oh, okay, it's for the next year.
You're supposed to pay this on 1st April, and we are preparing this on 31 March. So it will be paid immediately. It will be paid the next day after the reporting period. So we bring our deferred consideration as 60 over here. Then we add the finance cost to it because we are going to be paying them 66. So you can just put all the 66 over here, or you separate it so that maybe you can have more ticks for that. The deferred consideration is 60 and the interest element will be added so that we can get 66 to pay to the next day. So this will be a current liability because it will be paid the next day. All right. Let's total our purchase consideration now. What are we going to be having as a purchase consideration? What will be the total there?
$405.
405. Okay. So that will be 405. Okay. Let's continue reading. All right. So, Auntie BC, can you continue for us?
Some also incurred directly attributable cost of 2.4 million acquisition of own. This cost comprised of 1.4 million cost of issuing own shares charged to operating expenses, 1 million due diligence costs included in the carrying amount of the investment in SAN's own statement of financial position.
All right, thank you. Just stop there for us. They said that Sun also incurred directly attributable cost of 2.4 million on acquisition of Moon. This cost comprised 1.4 million, which is a cost of issuing own shares charged to operating expenses. Cost of issuing your own shares, how should it be treated? We look at this the last time. How should it be treated? Cost of issuing your own shares. It should be treated as what? Or we have forgotten. Should it be expensed or
Yeah,
issued?
it should be taken from the shares. That's capitalization.
Okay, it should be capitalized. The cost of issuing your own shares should be capitalized. But what has been done? They have charged it to operating expenses, isn't it?
Yeah.
So what we have to do is that we have to reverse that. Reversing that means that we have to debit our retained earnings because it has been charged to operating expenses. It means that the profit has been reduced. So we debit our retained earnings, then we now credit our equity shares. That will be the entry. Debit your return. No, it's not debit. Credit your retained earnings and debit your what? Your equity shares, because the equity shares, we have to subtract that from the equity shares. So you debit your equity shares to subtract the 1.4, then you now credit your retained earnings. You go and reverse it. It's supposed not to be charged to profit or loss. So we go and reverse that particular cost of issuing own shares. So cost of issuing own shares must be reversed. Okay. So cost of issuing your own shares must be what? Reversed. So that will be 1.4 because it was first charged as an expense. We come to our equity shares over here. We take 1.4 from here. It should be subtracted from what? Our shares, because the shares is seen as a liability. Okay, if you're using a business entity concept, it is going to be asset is equal to liabilities. Capital will be seen as a liability, or the cost of issuing should be debited to wherever it is going. And debiting the equity shares account means that you are reducing it. So that part has been what has been dealt with. Okay. So you capitalize it
Please,
and invest it from.
please, can you take the treatment again for me to see?
This should have been subtracted from equity shares, isn't it?
Yeah.
But we subtracted it from what? Retained earnings. So we go
Okay.
and reverse it, and we now subtract from the equity shares. So you debit your equity shares, and you now credit your retained earnings. Or if you are doing profit or loss, you go and subtract this figure from your operating expense.
It's rather added to the return.
Yeah, we are adding. It was taken as an expense, but it shouldn't be taken as an expense. So we go and add it back. Okay. All right. Let's come to the 1 million due diligence cost included in the current amount of the investment in Sans what own statement of financial position. How should the due diligence cost be treated?
Expense.
But what did we do? It was what? It was capitalized, isn't it?
Yes.
So you can see that is why the investment is 121. They have added what? The 1 million to it. So what we do is that we go and remove that. It should not be capitalized. So we go there and remove our 1 million from this place. Then we now go and what? And have the due diligence cost. It should be what? It should be expense. So we now come here and have 1 million. Someone can decide to bring only 0.4 million over here and do the remaining entry. Why? Because cost of issue will be 1.4, then you subtract 1 million. The net amount that you are adding is 0.4. But for presentation sake and for you getting more ticks, just do it one by one and move on. The diligence cost, all other costs associated with business combination or acquisition of a subsidiary should be expense up. Only the cost of issuing your own shares should be what? Should be capitalized. So they expense the cost of issuing their own shares, and they are now capitalizing the other cost, which is the professional cost or the due diligence cost. So we have to reverse that particular things that they have done. Okay. So we can now take the footnote proper. Okay. Answer BC, are you there?
At the date of acquisition, the fair value of Moon net assets were approximately equal to their carrying amount, with the exception of its property. This property had a fair value of 40 million in excess of their carrying amount, which will create additional depreciation of 2 million in the post-acquisition period to 31st March 2017. The fair values have not been reflected in new statements of financial position.
Okay. So what are they saying? They are saying that the net asset that we have calculated from the statement of financial position, we haven't included what? 40 million, which is the fair value being higher than what? Than the carrying value. So at the date of acquisition, the fair value of Moon's net assets were approximately equal to their carrying amount, with the exception of 8 properties. These properties had a fair value of 40 million in excess of the carrying amount, which would create additional depreciation of 2 million in the post-acquisition period to 31 March 2017. So at the date of acquisition, the net assets calculated, let's go there. We are using the book values, which is the carrying values. So they are telling us that this net asset that we have calculated over here, we haven't taken into consideration an increase in the value of a property. So a property is now increasing by what? By 40 million. So if the asset is increasing by 40 million, what will be the effect on the equity, on the net assets? The fair value is increasing by 40 million. What will be the effect on the what? On the Net assets.
You add it to the net
Okay.
assets.
It will be increasing the net asset. So you have your property here. So the property will be 40 million. So just put 40 million, 40 million, and come and take into consideration your depreciation. What will happen to the asset itself? Has the 40 million be taken into consideration in the value of the property, plant, and equipment?
No,
No.
we add.
We have to add
So
one.
So we can add the 40 million here. It is only going to be land that no depreciation will come. So sometimes the question will not give you additional depreciation. They will give you the remaining useful life of what? Of the asset. So you have to calculate the depreciation on the asset because the fair value was not taken into consideration. So depreciation was not charged. But you are now bringing it into the books. At what date are you bringing it? At the date of acquisition. But we are reporting on 31st March. This means that we are bringing it at the beginning of the year. And at the end of the year, the value will not be the same. We have used 1 year already. So we have to charge a depreciation. The question is telling you that there is a depreciation of what? 2 million in the post-acquisition period. Was the depreciation taken into consideration?
No.
No.
If the depreciation should have been taken into consideration, what would be the effect of this depreciation?
it would have reduced the cost of the asset.
Okay, it will reduce the asset by, so it means that the value of the assets now supposed to be 38 million, not 40 million, isn't it?
Yeah. Yes, sir.
So you come here and take your 2 million. What would the depreciation do again?
To have effect on the net asset as a result.
Okay, so if we should have known the depreciation would have been taken away from our profit for the year. The profit for the year will always be under the reporting. You can see that the profit for the year is 20 over here. So you come and take oh, so yeah. All right. So the depreciation would have been taken away from the profit for the year, which is 20 million, but that was not taken. So we come and do it. Or some people can say that the property they will just bring 38 at the reporting figure. There's no problem with that. Because the value of the property will be 38. Depreciation will be taken away from it. You'll be having 38. So you can bring 38 over there, or you can bring 40 and bring the additional depreciation of 2 million. Nobody is going to do anything to you. Okay. We are done with the first part now.
Please,
Yes, please.
out of if you mix the 40 and under the reporting and bring the 38, is it 38 or 2? 2 under acquisition.
If you no, you
When you take the 2 from the 40, you have 38, and then the difference between them is 38.
if you are taking the 2 from acquisition to have 38. Let me
Yeah, you have 38,
no,
and then you
cannot
take the
put
reporting from.
you cannot put 38 at acquisition. At acquisition, you have not used any portion of the asset. So you still have what? 40 million. It is for the year that you'll be using the asset for a year. So the depreciation can never affect the acquisition. The acquisition will still
I'm
be
saying that the effect between them, when you net it, the effect between the acquisition and reporting will be 2, right?
okay. If you the difference will be 2, yeah. That will
Yeah, so you just bring the 2 under acquisition, or you lose it.
no. If you are bringing the 2 under acquisition, what you are going to be doing that you are going to be having your net asset at acquisition higher than the normal net asset. At
But
acquisition, just be 40.
that's a position currently, because when you take the 2 from it, it will be 2 higher.
If you take the 2 from which one?
Property 40/40,
Okay.
40/40, but you net it and you have 38 as reporting.
And
So the difference between
that's what I'm saying, that you can put 38 at reporting. You will not bring the 2 again. You just put 38
oh,
at
okay,
reporting.
okay, okay.
You will not bring the 2 again. And I've said that. All right. Let's take the B. What are we having for the B?
The intellectual property is a system of encryption designed for Internet use. Moon has been advised that government legislation that passed since acquisition has now has now made this type of encryption illegal. Moon will receive 10 million in compensation from the government.
Okay, so they are saying that the intellectual property is a system of encryption designed for internet use. Moon has been advised that the government legislation passed since acquisition has now made this type of encryption illegal. Okay, Moon will receive 10 million in compensation from the what? From the government. So they are saying that the government's legislation passed since acquisition has now made this type of encryption illegal. When is the now that they are talking about? When is the now?
I think the reporting date.
Okay, the now is the reporting date. Okay, the legislation was passed since acquisition, but there was no issue of impairment at acquisition. It is at the reporting date that we have realized that okay, this particular intellectual property will be impaired by how much? So let's go. We are receiving only 10 million from what? From the government. We are receiving only 10 million. But what is the value of the intellectual property in the books of Moon?
40.
Date.
Okay. So we are receiving only what? Only 10
10
from the
million.
government. So what is that? It means that this intellectual property has impaired by intellectual property
By 20.
by 20. And that 20 will be at reporting. So you bring your 20 here as impairment. So let's go to the statement of financial position. So you can change the intellectual property to, you can subtract the 30 and bring the 10 as receivables here. Okay. Or you can even change the intellectual property now to receivables, since you are going to be receiving the 10 from the government. Or you can subtract 20 from intellectual property and still be showing intellectual property of 10. That is the value. Now, there's nobody's going to do anything to you. Or you can just bring the 10 as receivables from the government. So you remove all the intellectual property, then the 10 that you are going to be receiving from the government will now be treated as a current asset. Or you can subtract the 20 from the intellectual property and be left with what? 10. That is nothing. All right. So anyhow you go about it, there is no problem with that. So let's have only the 10 over here. Okay. So let's move on. Okay.
Signalano,
Yes, please.
there was a clause, the clause at the listen. So they say Moon has been advised the government legislation passed since the legislation it was passed since acquisition. So you have to take that.
You have to convince me why you are saying I should take it. What do you mean I should take it? Take it from where?
It says since acquisition. So it means that at the date of acquisition, yeah, it was illegal. So
When are they making it to be illegal? When are they telling you this is now illegal?
at the reporting,
But it was not illegal at what? At acquisition.
but it's still into bracket
Was it
pass.
illegal at acquisition?
Yes.
What shows that it was illegal at acquisition?
We say past tense acquisition.
Okay, so if the law has been there since acquisition and they are not enforcing the law, was it illegal?
So this one it will not take a retrospective. I don't know. I'm asking.
We are having a very nice chat. So you should be using answers. You should not be using questions to answer me. If you have drugs that you are what? If you have drugs that you are selling, there was a government legislation over there, but the law is not being enforced. Okay, so they have started enforcing the law now. And someone is telling you actually right now you cannot sell these drugs again. When are you going to be taking those drugs off from your books? Are you going to be taking it that the drug has not been there since what? Since acquisition? But you have sold some of the drugs before. They are now telling you that these drugs are not what? Are not uh, legal again. Will you go to the people and refund the money that you have what? The drugs that you have sold to them since the time that the law has been passed? Will you go there and give them the money back? No, you just, what is the remaining drugs left? Those are the drugs that you are going to be packing. The law has been there since acquisition, but they were not enforcing it. It is a reporting date that, oh, Charlie, these drugs now you cannot sell it again. You cannot go back and tell the people that the drugs that you have sold to them, they should bring the money and you will go for the drugs and what and throw it away. No, it has been sold already. So it is the remaining one that will be what? That will be scrapped. So this has nothing to do with acquisition. Unless the question is saying that at the date of acquisition, they are saying that the intellectual property is illegal. Unless the question is saying that at the date of acquisition, the intellectual property is seen to be illegal as a result of government legislation being passed. So at that date, the intellectual property will be only 10.
Please, sir,
Yes, please.
can we get to the net asset or subsidiary name system?
Okay. Sorry. All right.
Okay, sir.
Okay, let's move on. Yeah,
Yeah.
yeah, thank you, sir. Okay, let's move on to the C. Anti-VC.
C. Some policy is to value NCR using its proportion of the fair value of the subsidiary identifiable net assets.
Okay, so let's come here. Do we have any other issue that will affect the net asset at acquisition? Do you have any other footnotes here that will affect that? No. Okay, so we can comfortably add our so just add the net asset at acquisition. What are you having?
360.
Okay, so we have the 360. So there, what are we using for the goodwill? Are we using full goodwill method or we're using proportionate method? Okay, are we using a full goodwill method or proportionate method? SAN's policy is to value the non-controlling interest using each proportionate of the fair value of subsidiaries net asset. So the NCI is going to be having only the share of the physical asset, which is the 360. So it means that the parent is buying 70%. So what would be the net asset portion of the parents? So we'll be having 0.75 multiplied by the 360. Okay. So how much are we going to be buying? What is the value of the net asset that the parent is acquiring?
270.
Okay. How much are we paying for that? How much are they paying for that?
405.
So what will be the excess amount?
135.
Okay, so we have a goodwill at acquisition of 135. So we have a goodwill at acquisition of 135. If you want to add a net asset of the figure, if you want to add the non-controlling and interest to the purchase consideration and subtract all your 360, at the end of the day, you'll be getting your 135 as that. So anyhow you go about it, the NCR at acquisition will be 0.25 multiplied by 360. What are we getting?
90.
So that will be 90. Okay. So let's go to, we are done with that. That is for the calculation of the NCI. So let's come to the D.
At the beginning of this year's second quarter, Sun obtained a 25% equity interest in Galaxy.
So what
In
is that?
investment in associates.
So after that, you just have to go and create a space for investment in associates. So we now come to investment in associates here. So you have investment in associates or investment in Galaxy, anyhow you want to name it. So let's go to statement for financial position and have investment in associates. Okay. We come there. We have also have the goodwill of 135. Maybe there might be impairment. We come and net it there. Okay. So let's go to that question and what and read. Okay. All right, continue.
In exchange of this investment, Sun transferred a parcel of land with a book value of 30 million and a fair value of 36 million at the acquisition date
Okay.
to Galaxy former shareholders.
Okay.
Sun has not recorded this transaction, but the associated professional charges of 0.5 million have been included in Sun's operating expenses.
Okay.
During the current year, Galaxy reported annual profit after tax of 5.5 million, though its first quarter interim account this year had shown a loss after tax of 2.5 million.
Okay. So that is cool. Let's take it one by one. In exchange for this investment, Sun transferred a parcel of land with a book value of 30 million and a fair value of what 36 million as an acquisition deed to Galaxy's former what shareholders. Sun has not yet recorded this transaction, but the associated professional charges of 0.5 million have been included in Sun's operating what expenses. In Sun operating expenses. All right. So they are telling you that this particular the the consideration has not been recorded. So what do we do? What do we do now? What do we do? How do we record this? So what would be the purchase consideration for the associate? How much are we going to be recording?
36.
We are going to be the land is being given to them at 36. So you have your investment in associate, you have your purchase consideration to be what? To be 36. Okay. Okay. But what is the value of the land?
That
Okay. They say this has not been recorded. So the land is part of the PPE for the Sun again. So you go and take the 30 from the PPE there because land will still be here. But what is happening? We are giving something that worth 30 at 36. What is happening there?
There's again.
So you have your gain, the group, you have the uh gain, gain on the on transfer of land, and that will be shaped as a gain. All right, let's come to the other part. Some has not recorded this, but the associated professional charges of 0.5 million have been included in Sun's operating what expenses. What did we say about the professional charges associated with investment in associates? I've said something about that when I was doing the intro. I said something about the professional charges. I said something about the cost, the direct cost associated with investment in associates. Okay. So what we do over here is that, so the 0.5 should not be what? Should not be expensed. So we have the professional charges over here. Professional charges over here should be added. So what do? We count to return earnings. Then we reverse the what? That figure that has been charged. So we have the professional charges. We add back 0.5. Okay. Let's move on to that side. Okay. During the current year, okay, okay. During the current year, Galaxy reported annual profit after tax of 5.5 million, though its interim first quarter interim account this year had shown a loss after tax of 2.5. Okay, they say at the beginning of this year's second quarter, please, that this year that they are talking about is not 2017. They are talking about a reporting period. So at the beginning of this year's what? Second quarter. That will be from 1st July, because our reporting year is 1st April to 31 March. So at the beginning of this current accounting period, that's what they mean by at the beginning of this year's second quarter. At the beginning of the second quarter for the accounting period, that will be from 1st July. That was when the acquisition was done. Okay. During the current year, Galaxy reported an annual profit after tax of 5 million, although its first quarter interim account this year had shown a loss after tax of 2.5 million. Okay, this 5.5 that they are talking about, the profit which is 5.5, it is for how many months? The 5.5 is for how many months?
3 months.
No, please.
So 9 months.
No, please.
Is it at the beginning of this second quarter?
Forget about that one. Look at the question itself. During the current year, Galaxy reported annual profit after tax of 5.5 million.
12 months.
That will be 12 months.
For the whole year.
That will be 12 months, isn't it? Okay. That will be 12 months. Okay. That they have done 3 months before we acquired them, isn't it? They have done 3 months before the parents acquired them, isn't it?
Yes.
Okay. So, but they are saying that the profit for the total 12 months, it is what? 5.5. How do we find that? It will be the profit for the first 3 months. Okay. Plus the profit for the what? The last 9 months. Okay. And this will give you 5.5. But they are saying that the first quarter, which is the first 3 months before we acquired them, they made what?
They made a loss.
Okay. They made a loss of what? 2.5. So it means that during the what? During the 9 months, what was the total profit made?
3 million.
No, please.
That would be 5.5 plus 2.5.
Yes.
8 million.
You have a loss of 2.5 first.
And
Now it is now 5.5. So it means that
8 million.
during the 9 months, you have made a profit of what? 8 million, and that has reduced your loss to 5.5 as a profit. So you
Yeah.
have so you just find your 9-month profit to be 5.5 plus 2.5. So it means that during the post-acquisition period, they made a profit of what? 8 million. Okay. So you just come here, you have your share of the profit. So we have the share of the post-acquisition profit. Okay. And that will be 0.25 multiplied by 8 million. What are you having?
2.
That will be 2, isn't it? Okay.
Mm.
Please, the parent will only have a 9-month share of what? Of the profit in the associate. And that during that particular 9 months, we have to know the profit that they have made. The question is telling you that they have made a total profit for the year of 5.5, which is 12 months. But the first month, the first 3 months, they made a loss of 2.5 before we acquired them. It means that during the 9 months, they have made a profit of 8 million. And that's why our loss has reduced by the 2.5, and we are now having a profit of what? Of the 5.5. So that would be 8 million. And this will directly go to the share of the Galaxy's post-acquisition profit. Okay. Post-acquisition profit, we'll bring it to return earnings, and that will be 2. Okay. Let's move on. So that is all about that. Let's move on to E.
At the year end, Galaxy inventory included items worth 1.2 million bought from Moon. This item had cost Moon 0.8 million.
Okay. So at the year end, Galaxy's inventory included items worth what? 1.2 million bought from Moon. This item had cost what? Moon 0.8 million. So what are they talking about over here?
Intergroup trading.
Okay. So the intergroup trading is between who and who?
Associate and Moon.
Okay. But what will happen is that whatever transaction that we are carrying out, whatever transaction that is between the associate and then the
Parent.
the subsidiary. So the which will
And
be
Moon is
okay,
a
who is the
subsidiary.
subsidiary? Okay, and Galaxy is the associate. Whatever transaction that is happening between,
Okay.
they will be treated as if it is between the parent and then the associate. But just that the unrealized profit element over here will be given to the subsidiary, because they are the ones selling. Okay. What is the profit on this particular transaction?
0.4.
0.4. Okay. That will be the unrealized profit, isn't it? Okay.
Yes, sir.
Galaxy is not part of the group. So what we do is that if Galaxy want to account for this particular unrealized profit, the parent will only take what? 25% of it. Galaxy is not part of the group, so we don't have to go and subtract for inventory. So what we do is that we find a parent share of the unrealized profits. How much are we getting?
0.1.
Okay. This 0.1 will be taken from the investment in associate. But who is selling?
The associate.
No.
Sorry, the subsidiary.
So the subsidiary, this unrealized profit will go to the net asset of the subsidiary. So what you do over here is that you come here, you have the provision for unrealized profits. That will be 0.25 multiplied by the profit element on the transaction. That will give you 0.1. But this one, if it should be between the parents and then the associate, the parent will be the one to bear the 0.1 unrealized profit. But since it's the subsidiary that is selling, the provision for unrealized profit will come for the subsidiary to be 0.1. Okay. So let's now total our net assets. We have 360 here. What are we going to be having here?
357.9.
357.
0.9.
Okay, 357.9. What is the post acquisition profit?
It's going to be lost.
Okay, so post acquisition loss is what?
2.1.
2 points.
1.
1.
Okay, so 2.1. This will now be shared among the NCL. So we have share of loss. NCL will be having 0.25 multiplied by 2.1. What are they going to be having?
0.525.
0.5.
25, so 0.5 times.
Okay, 0. Okay, so we have 0.525. That is a loss, and the parents will be having a share of, okay, the share of the loss will be 0.75 multiplied by 2.1. What would the parent be receiving?
1.575.
Okay, 1.575. Let's do start the investment in associates. 36 plus 0.5 plus 2 and 0.1.
38.4.
So 38.4. So we have the investment in associates, 38.4. So you can just put the working there. Okay, working check, 38.4. Let's come to the goodwill. Goodwill will be working 3. That will be 135. Our intellectual property investment will be dash, will be dash. Okay, so let's come to our what will be the NCI?
89.475.
89.475. So our NCI, which will be workings number 4, will be 89.475. Okay. What will be the loan notes? 140. Okay, we have 140. Let's go to the group return earnings. Group return earnings. What are you going to be having?
There is 02.9.
3.
02.9.
Are you sure?
301.325.
Are you sure? And 6 plus 1.4.
So I didn't show the post acquisition.
Okay, plus 6
The post acquisition
0.5
loss.
plus 2. Okay, minus 1.
307.235.
I'm having 301.
301.325.
Okay, 301.325.
That's it. Is it gain on transfer of land? Is it addition or subtraction?
It's an addition. Okay, so we have the group return earnings when they
Oh,
were.
okay, there is 6 here. Okay, all right.
Okay, so we have 301.325. What will be the equity?
523.6.
523.
0.36.
Okay. What about the current liabilities?
346.
346. So 346. Our PP is what?
Nine eight seven
98.
seven.
We have a 987. So our intellectual property will be dashed. Our investment will be dashed. Our investment in associates will be 38.4. 38.4, and our goodwill will now be
135.
135. So let's put the assets together.
1,400.4.
So 1130.4. That's 240. 1400.4. Okay, so we are done with group accounts involving statement of financial position. That is it. 2 questions is okay for you. Tomorrow will be statement of profit or loss. All right. So if you don't have any question, those who are in Accra, those who want to go to work, you can now go to work, and I can also go back to my this thing. All right.